Record on computer. Okay. Our recording is in progress. So we're going to record this. I will then upload it to YouTube, and then I'll go into the Real Life Trading, into the Slack channel, and I'll share it with everybody. So, all right. So trading plans. Okay. If anybody saw my post that I put in Slack 45 minutes ago, I truly believe that those who fail to plan to fail. Right. So if you don't have a in-depth trading plan, and when I say talk about in-depth, we're going to go through mine and the components of it. But if you only have a couple of rules, that's not a great trading plan. Tony, he says he's having deja vu all over again. That's funny. Okay, so give me a 1 if you don't have a trading plan. Come on, there's got to be more than that. And this is no judgment zone. Tony's got a 0.5. Okay, that's good. So, and again, no judgment zone whatsoever. This is the reason we're here together, is to develop a trading plan, a comprehensive trading plan. So don't be shy about acknowledging that you don't have a trading plan, because it's normal. And believe me, the number of coaching students who I start working with don't have a plan. Or if they have a plan, it's really not adequate. It's not comprehensive. So let's talk about how we're going to structure our trading plan. Okay, you have rules. So Cindy, question. Okay, let me ask you, not to pick on you, but Cindy, you have rules for the way I am currently trading. My question for you is, are those rules in writing? Are they written down? Okay, good. Excellent. That's great. Because you'd be surprised how many people will say, well, I have a plan. And then my question is it written down? And like, well, no, it's in my head. So the key thing here is it's got to be written down. Okay. So that's what we're going to do. Okay. Yeah. So Justin, good question. Okay. So let me go back, just make sure Matt had a question, or Matt was staying. I have one, but it's kind of half swing day, half. Okay. And that's fine. So, so you can have a trading plan both for your swing trade, your swing strategies, and your day trading strategies. You can have 2 separate plans. That's okay. One to apply to each one. Mine is kind of a combined plan. So mine addresses both swing trade and day trading. And so Justin asked a great question. And I actually went over this the other day with one of my coaching students. So the difference between a plan and strategy. Okay. So the plan are the rules that you apply to a strategy, right? Strategy is completely different. Okay. You can have 20 different strategies that you trade, but your trading plan gets applied to those strategies. And the coaching student that I had the other day, where they were getting kind of hung up, was they were allowing the strategy to kind of dictate the overall big picture, right? So instead of looking at the big picture, looking at what was setting up in terms of a trend and everything, they were allowing the strategy to drive decisions versus let the trend drive the decisions, apply the strategy, right? So the strategy is what you're trading in terms of the setups. The plan is the rules that you wrap around all your strategies. So does that make sense? Perfect sense. Okay. And I'm glad that it made perfect sense to Justin, since he was the one who asked that question. And quite honestly, Justin was doing me a favor there. He is setting me up for a good answer, because I knew that Justin knew the answer to that question. So anyway, the trading plan gets applied to your strategy. So, and again, you can have multiple strategies. A strategy can be, when I was in Croatia, I was talking to a bunch of people about this very simple strategy, which is if you get a gap up and your first 5-minute candle is bearish, you go long on that. And then, Justin, you are lobbing those to me, and I appreciate it. You got my back. Thank you. And then, or the other strategy to that is if you get a gap down and the first 5-minute candle is bearish, you go short on that. Now that's a strategy, right? The 10 EMA strategy. That's a strategy that has rules that define the strategy, but the trading rules, your trading rules are different from that. So let me just start walking you through how I've constructed my trading plan. Okay. And I'm going to just start typing stuff here. So strategies are not plans, make a plan. Correct. Yep. You make your plan and you apply that plan to a particular strategy. Okay. So the way I have my trading plan constructed is I kind of have different, I've broken it up into sections for lack of better description. Okay. So my first section that I have is I have keys to consistency. Okay. And I should mention that before I even get into my plan, I do have, I just have a 1-paragraph kind of overview that gets me in the right frame of mind when I go to read my plan, because part of having the trading plan is you should read it every single morning before you start trading. Okay. So the key rules here for the trading plan are it's got to be in writing. Okay. You can't have it. You can't just have it in memory, right? It's got to be, you actually have to write it down. You can do it on the computer. You can handwrite it. Handwriting it actually helps to store it in your memory even better. But mine's on my computer. Okay. Now what I would do, or what I have done, is I've got my plan. I print it out. It's on a piece of paper. Every single morning I review it, I read it, and it's just a good way to, just a good habit to get into, and to read your plan and just remind yourself, even if you've been trading for a while and trading that plan, it's always good to go back and just review it every single morning before you start trading. So my little, 1-paragraph blurb that I have at the beginning, just to kind of establish my mindset, is, I'm just going to read it to you. I won't type this whole thing out, but I say, the market rewards the specialist, the disciplined, and the patient. Limit losses, pursue strengths, and take steps toward mastery. The market's going to do what it's going to do. So trust your analysis, take action, and then in parentheses, I wrote, with enthusiasm, and be patient. Okay. Yeah, exactly, Carl. Like a mission statement. Thank you. Great way to put it. Okay. So that's that mission statement at the beginning just kind of sets the stage for how I'm going to approach trading that day. So thank you. Appreciate the comments. Actually, I wonder if I can copy and paste that. Let's see if I can copy and paste it. I've not tried this yet. Copy. There we go. It worked. Here, everyone can read it now. Let me move this one out of the way. Sorry. Okay, maybe I can't do that now. I thought maybe I could just go back and highlight, but it's not letting me. Okay. So anyway, you have it here. Let me see if I can, I'm going to clear all drawings. I'm going to start this over real quick. Let's just start here. Control V. Okay. There you go. Okay. So there's my mission statement. So come up with your own, copy mine, doesn't matter. As long as you have something that kind of establishes your mindset going into the trading day. Okay. So then, as I mentioned, I break it up into sections, my trading plan. So the first section is keys to consistency. Okay. The next one, I have general guidelines. My next one is risk management. Then I have trade entry and management. And then I have just something that says other considerations. Okay, so by breaking this out into these areas, I then have bullet points underneath all of those. Okay, so I'll walk you through what each of these categories is and what I have. Okay, so keys to consistency. So I do a presentation for real life trading at different retreats. And the presentation I do is, and I'm going to be doing that actually, I think next week, I'm going to be doing the presentation in one of these time slots. I'm not sure off the top of my head when it is, but it is how to become a consistently profitable trader. Okay. And so the keys to consistency and the keys to being a consistently profitable trader should be part of your trading plan. So I have in mind, I'll just go through the list. So the first rule, and I already mentioned it in conversation here, is develop a daily routine. Okay. You should have a routine that you follow every single morning to do your prep, to get ready, to, again, get you in the right mindset to approach the market. So my routine is I now will get in front of my computers no later than 8:45 in the morning. Okay. So what I've been doing lately is my alarm goes off at 6. I get up. And again, when I say morning routine, I'm not just talking about trading. I'm talking about everything. So I'll get up at 6 o'clock in the morning, get on the treadmill. I will walk on the treadmill. I do, I don't run because my knees can't handle it, but I'll walk for 45 minutes on the treadmill, right? I get that out of the way first thing, so I don't have to worry about that. Then from there, I will get coffee, I'll shower, I do all those things. Then I am sitting in front of my screens by 8:45 at the latest. Sometimes 8:30. Like if I know I'm going to be on the mic, it's usually about 8:30 because I want to start doing a lot of prep. So again, it's not just your daily routine of trading, it's the big picture, right? Again, I've exercised, I've got myself in the right frame of mind. It's like I'm energized, I'm ready to go. So then 8:45, I start looking for gaps. So I did when I day trade, and I'm going to be talking a lot about day trading here because that's what I'm focused on right now with the funded account. So so I start looking for gaps, right? And I'll look at my scans. I'll go through my list of the companies that the tickers that we're using for the 10 EMA strategy, and I will start doing my prep with those. I'll move my lines around. If you've been in the room with me in the morning, I go through all of the lines that I have on the chart where I mark off the previous day's high, low, the pre-market high and low, all those things, moving averages. So that's part of my daily routine. And I would do that from 8:45 until market open at 9:30. So when the bell rings at 9:30, I'm ready to go. I'm not scrambling around trying to get things done, trying to figure out where my lines are. You got to be disciplined. You have to go into the market ready to go. Then that's developing daily routine. Then I have I tag trades and I import them into some type of a the examples I give here. So is everyone here? Does everyone familiar with TraderView? Not TradingView, TraderView. I'm going to type it here in the chat. TraderView. Okay. So great resource. Let me hang on a second. I hope we're going to have enough time to get through everything that we need to look at. Okay. Can everybody see my Google here? You see the whiteboard. Okay. Okay. Give me a second. Give me a second. Okay. You still see the whiteboard? Yep. Okay, cool. All right. That's fine. Here, I'm going to show it to you right now. Okay. There, you can see it, right? TraderView. Yeah. So great resource. They have a free version and a paid version. Okay. And you can actually import your trades directly into TraderView. I'm not going to go into the details of what TraderView does, but research it on your own. Again, the free version is great. Again, you can import trades directly from your broker into it. You can do all kinds of analysis, run reports. So it's, again, they have a free version and they also have a paid version. So I highly recommend checking that out. Let me go back to my whiteboard. Okay. So then the other one, like, so the one that I use right now, I do all my notes in, I record all my trades in Microsoft OneNote. And so okay, you are seeing the whiteboard again, right? Yeah, cool. So I import, I do a screenshot of my trade. I put it into OneNote. And if anybody saw some of my posts, I always put in, basically what the trade setup was, what I was thinking. Then I go into a breakdown of, the trade itself, what I did right, what I did wrong, just an overview of the trade and what I was thinking at the time. And then I always include a section that says, things to improve. How can I improve? Because, you always have to be able to do better tomorrow than you did today. So I always include an area, some analysis on how I can improve. So log your trades, very important. And the reason I like using, personally, like I like using OneNote is because I can do a screenshot and I can do the chart and I can make notes on it and I can put my entry, my stop, all kinds of notes. I can highlight candles, do all that kind of stuff. So for me, it's more of a visual thing for me. So I actually use OneNote. I did use TraderView for some time, but OneNote for me is my go-to. But you can use any system that you want, but definitely log your trades. So then I have analyzed stats on each trade to identify your edge, right? So the edge is, what is that strategy that you're trading that works really well for you, right? And that's going to change as the market changes. So for instance, there's a strategy that I was doing previously that before this, downturn in the market that was amazing. And I was, in 30 days, 20 to 30 days, I was making 20 to 30% I was pyramiding in and I was selling naked puts and I was then selling cover calls. But then the market just kept going down. So that strategy is no longer applicable. As soon as we get back into a bullish market, they will be. So constantly analyzing your stats so that you can identify your edge, and your edge is going to change. Your edge one day might be, you might excel at trading retest gaps, and next time it's trading a while later, that's not working, but then you find that gap and goes are working really well. So anyway, define your edge, figure out what's working well for you. Okay. Add everything, even your losing trades, especially because you can learn more from your losing trades than you can from your winning trades. Add all that to your, when you log your trades, review those, find the trades that make the most sense to you. Okay. And then those should be your go-tos. And again, sometimes they change and sometimes they stop working for a time period, but everything is cyclical. It will come back around. And identify your trade, identify and trade your best setups with measured edge, right? So another point about edge is, think about things, record things in your, when you're logging your trades, what was the catalyst? Okay. So typically when there's gaps, there's some type of catalyst behind it. Was it a news event? Was it earnings? Was it a competitor, did something? Was it poor estimated, earn, whatever it might be? There is usually a catalyst behind a gap. So figure out which of those catalysts, which are give you that measured edge, figure out which of those is most effective. Again, we're still on the keys to consistently. So consistently trade a predefined R. Okay. So what I mean by that is, don't change your R. Don't go, okay, well, this trade, I'm going to do a full R. And then you lose a couple. And then you're like, okay, I don't want to lose another full R. I'm just going to trade a half an R. Right. Well, next thing you know, you win on that half an R, but you haven't made up one of your full R losses because you only traded a half an R. So always trade the same R. Now, that doesn't mean that you can't modify that rule in certain circumstances. So let's say you're going to test out a new strategy, okay? And let's say that new strategy that you want to test out, you've already back traded it a ton. Now you want to actually implement it with real money. Okay, there I allow myself to reduce my R for that strategy, not for every trade that I take, only every trade I take for that particular strategy. So is this making sense to everyone? I know I'm just talking a lot because there's a lot to get to. Okay, cool. Should you be 100? So Justin, should the R be 10% of your account? That's entirely up to you. Okay, it could be 10%, it could be 1%, it could be the R that you, especially if you're new. So let me just address this. Okay, one of the things that I recommend for the new traders or people who are struggling, set an R to be something that is insignificant to you. Okay, so if you lose that R, it's not going to have a huge psychological impact on you. Okay, so especially let's say you've had a period of extreme losses, right? And you just can't, and now you're messed up mentally, right? Psychologically, you're shot because you've had so many losses. It's okay to reduce your R. So I don't have a defined amount for an R, right? So some people say, well, make it 1% of your account. Okay. Well, so perfect example. Right now, I have the $200,000 funded account, right? So in theory, if I'm following the percentage rules, my R should be $2,000 per trade. Well, I'm not doing that because I'm still getting used to the funded account. I don't know the nuances of it. I'm still trying to figure it out. And even like today, great example today, in the funded account, I shorted Delta and I put in the order, it triggered, it flashed up there. I was in, I walked away, came back, and there's no trade on my screen. I'm like, what happened? I saw it enter. Like I was there. Like I know for a fact that trade went through and it was showing up on my screen and suddenly it's gone. It's not even active. I go into the trade history and it's there. I see the trade and it says profit 0. So the funded account took the order. I was triggered into it. And when I walked away, I didn't realize it then canceled the order on me because I didn't know, or maybe I didn't remember that there is a maximum lot number for different accounts. So if you don't know this and you do have a fund account, good to know. So the 100K account, you have a maximum lot size of, well, that would be 10, right? For the $200,000 account, that maximum lot size is 20. My order on Delta was 25. And I was going short on it. And this was when everybody in the room was going long on it. And I was going, I think this is a short. And I went short on it. And because I had my lot size at 25, it canceled my order on me after it actually accepted it. And I didn't realize it. I was like trying to figure out what's going on. And then somebody actually in the chat did inform me that there is a maximum lot size. And I confirmed it with Matt DeLong. But, then I watched that trade. Man, that's 50 if you have a $500,000 account. Okay. So I have a $200,000 account. If you have the 500,000, it's 50, but I don't have that. So anyway, long story short, I watched this run. It not only ran to my 1.2 level, it went to probably 2 or 3 R, that trade. And I was not in it. I just had to watch it run. Then I took Delta again off the bottom. There was a hammer off the bottom, a reversal, got into the trade. It went in my direction. I'm like, great. I started trailing my stop. Yeah, for sure. I'm going to remember that lesson. But anyway, started trailing my stop. Well, price came down, never hit my stop level. So let's say if the pennies of my stop were 78, if my stop was, let's say 77, right? Whatever it was, $30.77. I don't remember the exact number. It came down to 78. That's where it hit the price and it stopped me out. Well, trailed me out. I still made money, but it never even got to the 77 cents. It got to 78 and it triggered me out. And then I watched it run right to my 1.2 level. Right. So anyway, the story there is understand the nuances of, if you're using the funded account. But back to what I'm using for my R is I'm not using 1%, right? I'm not trading. I'm not doing a $2,000 R with the funded account because I'm still figuring this stuff out. I don't want to be losing $2,000 on a single trade when I have to remember that I need to pad my stop a little bit more, because it will trigger me out within pennies even though it doesn't hit my stop. So I'm trading a $500 R on the funded account, and I'm doing that until I get comfortable with it and until I understand all the nuances of it. Does that make sense to everyone? So, trade what you're comfortable with trading, right? Don't let these random rules dictate what you decided, what your R is. Your R should be whatever you're comfortable with. Okay. So, hey, Robert. So anyway, trade the R that makes sense to you. Okay. And again, everybody has a different size account. So pick a dollar amount, use a percentage. That's entirely up to you, but always trade the same R. Okay. Logistical troubles. What kind of logistical troubles? I'll see if he can. I'll just continue. My next thing is accept the risk or pass on the trade. So if you set up the trade, right, accept the risk. So keep in mind, like when I look at trading, like, getting into a trade, it's like, paying for a ticket to get on a ride at an amusement park, right? There's a cost to get into the trade, and your cost for finding out whether you're right or wrong with your analysis is the cost of that ticket. So I say accept the risk or pass on the trade. Set it up, and it's either a good trade and you like your analysis, or you just pass on it. Pay yourself as the market makes money available to you, right? And again, these are just under the heading of keys to consistency. So I'm a believer in taking partials, right? I don't try to hold 100% of my position all the way to my final target. I like to pay myself as the market makes money available to me. That also helps you to lock in profit. If you think about it, if price moves in your direction and at a certain level, you take 10% off and then you move your stop, think about how much you just immediately reduced your risk. So you might have been you would have gone from risking a full R to you took 10% off, you moved your stop. Now you may only be risking a half an R on the trade. So it's capital preservation, and it is also locking in some profit. So I'm a believer in doing that. And what I'm doing now is I'm following Jeremy's recommendation, and my partials are 10%. So I will take, I'll take 10% off. And is this, Robert, is this RT3? Yep. No, dude, you're good. I'm on until 5 o'clock. So I've got from 3:30 until 5. So you're good. Maybe you got the days mixed up. Oh, you need me to cover till 5:15. That's fine. I'll keep going. That's fine. I got plenty to talk about. Enough. Give me a second. My microphone changed on me for some reason. Not sure why it changed. No, it's still the same. Okay, everyone can still hear me okay? Sound great. Okay, thank you, Justin. Okay, so accept the risk or pass the trade. Here's a great one, especially for new traders, okay? Act without reservation or hesitation. That is so key. It's like, look, if you set up the trade, like I know there are so many people who will set up a trade and then they don't execute it. They don't click it. And it's like, and they're waiting. It's like they get analysis through paralysis. They are paralysis through analysis. I said that backwards. If the hesitation is just you not being confident in your analysis. But if you set it up you got to take it. And so act without reservation or hesitation, right? Especially if you see a trade. The worst thing is, and I'm sure everyone here has experienced it, and I still experience it, because I might go, I'm not really sure. Like, I might start questioning the setup, and the next thing you know, it goes right to your target, right? How many, give me a one if that's happened to you. If you've set up a trade, didn't click the button, and then you just watch it go. Justin, never. Yeah, dude, people, I shouldn't say dude, because we're all men and women here. It happens to all of us, right? So don't think that you're unique in how that happens, okay? So it happened, Andrew said it happened way too much this week. Thank you for that honesty. And look, that's the thing. You just have to act without reservation and hesitation. And that goes back to the previous bullet point, which is act without reservation or hesitation, right? Trust your analysis. And then my next line is continually monitor your susceptibility for making errors, right? Learn from your mistakes. And when I say mistakes, I should correct that term. I don't like the word mistakes, okay? Because every single, if I'll use the term just to make my point, every single mistake you make is a learning opportunity, right? So I don't think of them as mistakes. I think of them as learning opportunities. So monitor yourself, right? Be aware, be conscious, be aware of the mistakes that you make, the learning opportunities that you are presented with, and take advantage of those. Another key point for new traders or developing traders or people who are struggling, okay? Be patient and accept the very real learning curve, okay? There is a learning curve in trading, right? And it's real, and it's, for some of us, it's steep, and that's okay. Everybody learns at their own pace and at their own time. Don't feel that you're in competition with everybody else in Slack. And I want to hammer home that point, because I know there are a lot of people, and forgive me, because some of these points take me off on a tangent, something else, but it's all relevant. So in Slack, right? We all see these posts. I made 30R this month. I made 10R today, or I made, whatever. It's like, and it's a natural thing to look at that and go, why are these people making so many R's and I'm struggling so much? Anybody experience that? I know I have. Give me a one if you've had that experience. Yep. You look at that. So the best advice I can give you is ignore the noise. Okay. Don't pay attention to that stuff in Slack, right? Because here's what, and I'm not calling out anybody specifically. I'm just saying people's tendency is to let you know about their wins, not their losses. Okay. The last week of June, when I had to post my loss for the month, because I had just started the funded account. I still need to post all those losses in Slack. I racked up a ridiculous number of losses in those last 2 weeks, because I'm trying to understand the nuances of this, of the funded account. And well, I'm using MetaTrader, not the 8cap. Well, it's 8cap tied to MetaTrader. But anyway, I'm still trying to figure out all these nuances. And, so that's, again, back to why I'm not, why I'm trading a smaller R on this, because those losses, if I was trading a $2,000 R with all that, I'd already blown up my account, right? And it's not that I'm doing anything wrong, other than I'm learning the platform, right? And I need to better understand all these little nuances to it. And once I do, that's fine. I can up my R. But don't pay attention to all the noise in Slack, because people want to tell you about all their successes and all their wins, but you don't see a whole lot of people coming forward and being honest about their losses, right? So we last night we had an ROT call, and Matt was talking about a guy who was like, confided into Matt that, one day and apparently this guy must be a big money trader, and one day he lost, $200,000 in a day. And he sent that to Matt privately in a message. And he's like, lost 200,000. Well, the next day, Matt follows this guy on Twitter. The next day, the guy's on Twitter, he's bragging that he made 120,000 on that particular day. So, but he never mentioned the $200,000 loss. But he's on Twitter now promoting the fact that he made 120. And that's like, okay, but you're still down 80, right? So just understand, everyone, that, you know, take what you read in Slack with a grain of salt in terms of wins, losses. Okay, you're in competition with yourself, nobody else. Don't let Slack make you feel like you are not doing as well as you should. Okay, again, everybody learns at their own pace. Everyone progresses at their own pace. Okay, my final point here under keys to consistency is fully accept the necessity of the above principles and never violate them. Okay, so that's how I finish off my keys to consistency. I wonder if I might have to clear all this stuff at some point, but here, let me do a screenshot, or not a screenshot. Let me copy this. See if I can put it here. Okay. Oh boy. Hang on. Try it again. If you haven't been able to tell, I'm not exactly a pro at the whiteboard thing. Okay. So you can see it all there, right? And again, this is being recorded, you know, and by the way, I'm happy to also email anybody who wants a copy of my plan if you want to use it as a template for your own. Okay. But there's my keys to consistency. Okay. The ones I just went over. So let me clear this. I'm going to clear the whole board. And again, so anybody who here, Manveer is saying yes, please. But look, if anybody here wants it, just if you would email me the request. So send it to Stephen@reallifetrading.com. Put it in here. Stephen@reallifetrading.com. Okay, there's my email. Email me and then I'll just reply to it. Okay, because I won't remember by the end here who all had asked. So just email me directly. All right, let's clear all of this. Okay, now, next heading is general guidelines. Okay, so the general guidelines, again, are in the presentation that I give for keys to consistency. Well, no, it's actually called, you know, how to become a consistently profitable trader. Okay, in the presentation, I emphasize, and I do this with all of my coaching students, I emphasize that what you trade is as important as how you trade. I'm going to actually, because I think that's a pretty good statement. Okay, up here. What you trade is as important as how you trade. Boom, big statement, right? All right, what does that mean? Great, nice statement, but what does it mean? Well, what it means is have rules around what you can trade, right? So I'm going to walk you through. Okay, so my first one is only trade liquid stocks and avoid low float ones. Okay, so what do I mean? Make sure you can get in and out of a position, right? Some of these, you know, penny stocks or these low price stocks or low float ones that don't have a lot of volume, you can get into the trade and then it doesn't go anywhere and you're sitting there. And this, look, it's happened to me. I don't trade these anymore. Back when I didn't know what I was doing and I had no right or no business clicking buttons trading. And believe me, there was a time, and sometimes I still think there is. But getting into a trade that doesn't go anywhere, and then you're in it for like an hour and a half and it hasn't moved. I mean, literally hasn't moved. And you're like, it might go up a penny, down a penny, up a penny, down. Next thing you know, it's like, okay, the only way, and let's say whatever the spread is, that's going to kill you, right? So maybe there's a wide spread on it. But yeah, I've been in a trade where for like an hour and a half, I'm like, this is just killing me. Like so I just took a loss just to take a loss because I had to get out of it. And that happens. And I'm going to give you guys a great example. Okay. So I met a trader in Croatia who was who is, I shouldn't say was, who is a crypto millionaire. Okay. But the story that's important here, that's relevant, is he told me that the currency he got into, I don't remember what it is. It's not, it wasn't one of the ones that we all know. He got into it. He was a plumber before he got into crypto, right? Hardworking guy, blue collar dude, a plumber. Put $13,500 into this cryptocurrency, whatever it was. It went up to, his account went from 13,500 to 24 million. 24 million with a $13,500 investment. Is that not insane? Ridiculous, right? $24 million. Now, here's the catch. He couldn't get out. He could not take his profit, because if he took his profit, it would have crashed the currency, because he had such a large stake in it that he couldn't remove his money, because if he took his money out, it would have crashed that currency. So his account was helping to prop that currency up. And all it would take would be one person to start pulling out profits. And then next thing you know, it's a waterfall. Everyone's doing it. So that is a liquidity trap. And that's what I mean by only trade liquid stocks and avoid the low float ones. Make sure that you are trading something with liquidity that you can get in and out of. In the end, he ended up his, Juan, it's Stephen, S-T-E, here, you know what? I'm loving my whiteboard stuff. Let me do it up here. Ready? I'm becoming a whiteboard expert in this. There you go. Stephen at reallifetrading.com. Boom. So he ended up, and look, this is still very respectable. I mean, more than respectable. Like, I would die to have this kind of a move. He ended up getting out eventually, because it did start to crash. And he got out with $750,000. So under $1 million. So think about how you would feel if you went from 24 million in profit to pocketing 750,000. Now, two ways to look at it, right? Glass is half full, glass is half empty, right? I'm kind of that guy who would be going, I can't believe I could have had 24 million in my pocket and I end up with 750. Then I would have to remind myself, well, you got $750,000, right? Exactly. It's still a life-changing number. So I don't mean to belittle it. It's an amazing experience and an amazing thing to have happened to him. But the point here is, make sure that you're trading stuff that's liquid, that you can get in and out of. You don't want to get stuck in something that you can't get out of, especially if you're holding overnight. Okay. Average daily volume. Okay. So all of my scans, everything I do, my average minimum daily volume for anything I trade has to be 500,000 or more. Okay. That's right in my rules. If I look at a stock on a chart that's gapping and it looks like a great gap, and it only trades on average 150,000 shares a day, 200, it doesn't even make it on my list. I don't even look at it. Immediately disqualified. So it's got to be a minimum of 500,000 shares or more per day. Okay. ATR. Does everyone know what the acronym ATR stands for? I mean, I'm going to tell you anyway. I'm just curious how many people know ATR. Average true range, right? You hear Johnny talk about it. Yep. So average true range. That's how much you can expect something to move on average in a day. So my rule is I can't trade anything with a average true range of less than 50 cents. Okay. And really, I kind of look at it more like 80. That's my ideal number, is 80 cents for average true range. And the reason why, you might wonder, why do I have that? Well, the reason is, how much do you think a 20-cent stock is going to move during a day, right? Think about this. You're not getting in at, let's say you're going bullish. You know for sure you're not getting in at the very bottom of the day. right? You might get in somewhere about the midpoint of the day, right? Nobody's buying the absolute low or selling the absolute high, right? So the minimum average true range keeps you in stocks that are going to move, and you want stocks that are going to move. The higher the number, the better, right? So that's why we trade Tesla. That's why we trade AMD and Apple and all the ones that have a large average true range, because they move, right? So don't get caught up in these cheap little, $5 stocks that only move 20 cents a day. It's not worth your time. Okay. Then I define stocks with edge will have an average true range of 80 cents or more. Volume. So the volume on the day, 1 million to 10 million is a great range to look for. Again, I have my minimum of 500, but I'm talking about stocks with edge, things that are going to move. Volume of 1 million to 10 million. Now I have a thing in here called relative volume. It's not something, it's something that the institutional traders have access to, but for us retail traders, it's not something that we even have access to in terms of a real-time number. So it's there, but you can ignore it. A short float of ideally of 30% or less, but ideally 20% or less, right? So you don't want something with a very high short float unless you are more experienced and you are actually looking for that, that squeeze, right? So the short float is how many people have sold it, right? How many people are holding that particular stock short. So if it's a high short float, if it's like 50%, if you're experienced in trading, you might be looking to get into a squeeze, right? So squeeze out the bears. And that's what happened. If you all remember what happened with GME and AMC and some of those other Wall Street bets, tickers, right? That was a short squeeze. Right? All these people got together and saw that there was a high short float on these stocks, and they all banded together and they squeezed out the bears, right? So, again, don't get caught, be aware of what you're trading in terms of the short float as well as everything else. All right. New traders. I touched on this morning. If anyone was in the room, I said, for a new trader, as a general rule, be bullish when price is above the 50 SMA on the daily and bearish when it's below the 50 on, well, I said daily, but let me clarify. Above the 50 on the, be bullish, and below the 50 SMA, be bearish on all time frames. So what do I mean by that? Well, when I trade, I'm always looking at multiple time frames. So that's the term multiple time frame analysis, right? So I'm looking at the 3-minute chart, and it depends on the time of day. So initially I'm looking at 3-minute, 5-minute, 15-minute, right? I've also done my analysis on the daily chart, right? So when I say, as a general rule for new traders, be bullish when price is above the 50 and bearish when it's below the 50. You want that to be the case on all time frames, even on, if you're trading a 5-minute chart, wait for that. Again, the more experience you get, the more you don't have to be so concerned about that 50, but when you're starting out, it's a pretty good rule to follow. It will keep you, basically it's keeping you in the right trend, right? So above the 50, bullish trend, below the 50, bearish trend. So this is interesting because I need to update this based on the current market conditions. Okay. So what I had in here was the majority of trades should happen after the first 30 minutes. Be patient. Well, I recently have, even though I haven't updated my plan for this, I now have that to an hour. If anybody heard me this morning, I'm actually following Jeremy's rules right now for the existing market conditions, and I'm waiting an hour. So that's not to say that I won't jump in after 30 minutes, but I really am being patient because Jeremy noticed it now that he mentioned to me, and I'm. Sorry, could you say that again? Sorry, that she thought I was saying, you know who. I've just noticed that the first hour, there's a lot of whipsaws, right? A lot of choppiness. So, and sometime, and all the back trading I've done is to, I've noticed that the trade setups that I'm looking for are all happening somewhere after 10 o'clock. So 10:20, 10:30, those are the times that I'm noticing that my trades are setting up. So have a rule about that, right? There's no reason you have to jump into the market right away. there's just, again, because there's a lot of choppiness. Okay. I trade gaps. So for all of you who trade gaps, I have a rule here that says the best gaps are when people get confirmed bullish, bearish the prior day, and the gap is in the opposite direction, right? So I'll talk about, well, retest gap, gap and go, right? So just think about if it's a bearish candle the previous day and it's gapping above that. So all of those, so gap and goes basically pretty much, yeah. I mean, it could also gap above, let's say, if there's a high wick, let's say it could gap higher low wick. It could gap above or below the close the previous day. That's also good, right? But the best is when it clears the whole candle, right? So anyway, the gap should clear at least, I'm sorry, the best gaps are when people get confirmed bullish or bearish the prior day, and the gap is in the opposite direction, thus trapping those traders. Then the next one is the gap, ideally, okay? Ideally, this doesn't mean it has to happen all the time, but ideally the gap should clear at least one pivot point. The stronger the pivot, the better the gap, right? So sometimes you might see, you know, let's say if you have, let's go back to the whiteboard. Let's see if I can draw a, okay. Let's say you have a big bearish candle, okay? And I'm not going to change the colors. I'll just follow along with me, okay? Then you have another bearish candle, okay? Then all of a sudden you get a gap up into here, okay? So when you look at that, okay, big bearish candle, let's say this is another bearish candle, and all of a sudden you gap above this, right? So here's the thing. Yes, technically that is a gap and go, right? But do you think that all these people, all these bears here are panicking yet? No, because it didn't go above here, right? But let's say, what if it gapped up and opened there, right? So next thing you know, right, all these sellers, they're trapped, right? So that's what I mean by it. If it's clearing a pivot, ideally you want to see it clear a pivot, and the pivot would be the last high made, right? Doesn't always happen, but just bear in mind that the, you know, so I did that, bear in mind, it's kind of a play on the bear candle. Pretty good, right? Just keep in mind that that it should clear at least one pivot, and the stronger the pivot, the better the gap, okay? But that doesn't mean that you can't find really good trades that don't clear the pivot. Note support and resistance on the daily chart, okay? And especially if it occurred in the last year, it's significant. So, you know, I probably could update this because, as you all know who listen to me, on every single time frame I'm trading, I have the higher time frame moving averages plotted out. So if I'm looking at a 5-minute chart, I can look at that 5-minute chart and I know where the daily moving averages are. I know where the weekly are and the monthly. So I know where all those major moving averages are. Plus, I will also drop in lines for major support and resistance. Okay. So the more information you have without cluttering up your charts, you really don't want to, you know, you don't want to create a eyesore, but, you know, the more information you have, note the support and resistance. Key things: know the previous day's high and low. Know your pre-market high and low. Moving averages, the higher time frame moving averages, and the major support resistance areas. Okay. Ideal gaps. So for me, my ideal gap is 2 to 7%. So a 2 to 7% gap for me is perfect. The gaps of 7 to 9% are good for aggressive shorts. Okay. Now, this next line I have, it says, be careful of gaps over 22%. I really don't even look at anything that's gapping over 12% now, right? So back when I created this plan, if you think about it, 22%, do I have a scanner that I prefer? Yes. So I have an account with Interactive Brokers, and that has a real-time scanner that you can do pre-market scans. right? So I have my scans set up based on all of these trading guidelines that I just went over, right? So the average daily volume, what I'm looking for. So it's all built into my scans, and that gives me, and it's a really good pre-market scanner. That's Interactive Brokers. You can also do that trading view, but you have to pay for the data. Thinkorswim, unfortunately, even though I love the Thinkorswim platform and that's what I use for charting, the Thinkorswim platform does not update your gaps until after the market open. So you cannot do a pre-market scan with Thinkorswim, and that really kind of bums me out. But I get it done with Interactive Brokers, and if you have IB, you can do it there, or if you have TradingView and you're paying for the data. Trader Workstation, I'm not entirely sure. I don't use it. I don't have experience with it. If there's anybody here listening, if you do have experience with Trader Workstation, if you know whether or not you can do a pre-market scan, please put that into the chat here. All right, so be careful of gaps over 22%. Again, I really should update that and say 12, right? Because if you think about it, anything that's gap 12%, it's already made a big move, right? How much more is it going to move? And yes, everything can continue to go up or down, but I figure the way I look at it is there's probably better gaps to look at, because chances are something that gaps over 12%, especially get things that gap over 20%, it can just gap and then just go sideways the rest of the day. So I just ignore that immediately. If I see something that's gapped over 12%, I just, I might look at it, but for the most part, I'm not putting it into my watch list for the day. Okay, Rock agreed with that. Thank you. Glad somebody's got my back here, Rock. Appreciate that. I'm kidding. I know you all do. Fade. Yeah, exactly, Albert, right? So something that gaps that much, absolutely. I'm always thinking fade on something that gaps that much. So good point. Thank you for adding that to the chat. Be cautious of setups where stock has already traded to a target and bounced, okay? All the more reason why having these levels on all of your charts, regardless of the time frame, the 5 minute, the 3 minute, 1 minute, whatever it is, right? If you mark out the areas of support resistance and the stock has already moved and hit a target, I'll typically just take it off my list, right? Because when things hit a target like that, they will often just go sideways, okay? Or the other thing is there, back to Albert's comment, fade. Maybe then I'll look to fade it. So for instance, my Delta trade today that ended up being like a 0.1 win, and it should have been like 1.2, but I'm not, upset about it, if you can tell. If you think about that, I took that trade off the bounce, right? It traded down to a target. So I'm not getting, and it was going, and at the time that I took it, it was going bearish, right? And I took it bullish because it traded right down to, I forget off the top of my head. I want to say it was like the pre-market low, and then it threw in a hammer candle. I'm like, well, there you go. Pre-market low. That would have been if I was in short, which I should have been as well, that would have been my target, right? The pre-market low or the previous day's low, somewhere, whichever came first, that would have been a target of mine. So when I saw that hammer come in at that target, then I'm expecting the bounce. So that's right. I'm still not quite over it. Give me time, Justin. So again, when I saw that, I wasn't thinking short any longer. Then it's bouncing. Okay, so it traded to its target and it was bouncing. So I'm not going to go short on it. Now I'm going to look to go long. I'm going to look to fade it, as Albert mentioned. Don't take trades that require the stock to make an abnormally large candle in order to hit your target. Okay, so anybody who was there this morning, right? So Twitter opened up and it was a gap down. Was it Twitter? I forget. There was one trade that I looked at today. No, it was something gapped up. And anyway, it gapped up. And one of my trades that I look for is, I already mentioned it, is a gap up. And if the first 5 minute candle is bearish, I will look to go long on that. I'll bracket that and look to go long. I set it up. Then when I looked at the daily chart, I realized just to get to my target, it would almost need to make a candle twice the size of what it usually makes. Again, I forget the ticker, but so right away I discounted that. I was like, nope, I can't take that trade because it's asking it too much, right? Even though that's my setup and that's something I look for, what it needed to do in order to hit my target would have been just too much, right? So curtail your expectations. And if you see something like that, whenever you set something up, always look at the daily chart, go back, look at the daily, see if there is room for it to go to your target. And if there's not, don't take the trade. Don't fade gap and goes. Petra, I'm coming in late. Please excuse me, possibly asking a question that was already answered. Will you send out this recording? And if so, where can I find it? Petra, absolutely. I am recording this and I will, I'll process the video after, and then I will post it in Slack. So assuming that you're in Slack, and I know you are because I think you are anyway, but it will be in Slack. So yeah, so I'll post it there. Okay. Okay. Yeah. So Justin, yep. If you don't mind, if you want to, because I'm not monitoring Slack right now. If you want to just let people know, I will post it there. That'd be great. Okay. So moving on. Don't fade gap and goes. That's in my plan. Okay. The number of times I've lost trying to fade gap and goes, I learned the hard way. I built it in my plan. I don't do it. So even if I see a great setup on a gap and go, it's in my trading plan. I have lost too many times. I have had way too many learning opportunities. Notice how I did that. And I don't fade gap and goes. And I think that is a really solid piece of advice for anybody, because a gap and go should have strength, right? And it really should not retrace that much, right? You might get some small retracements, but it's, so Petra, fading is when you go in the opposite direction of the trend. So let's say if you had and Petra, I know that you and I have had conversations in the chat pane about, what a gap and go is, right? So if you think about it, if you had a, back here on the screen, right? So I gave this example, you just got in, but let's say if this was a bearish candle and this was a bearish candle. So bear candle, and all of a sudden, forget this one right here. Look at this one. Let's say next day it gaps up, right? And this opens. All of these traders are trapped, right? I'm expecting, what I am expecting at that point is for price to just go like that, right? That's not to say that it won't do something like that, right? It's going to have a little bit of retracements, but it's not going to be a retest gap that goes like this, and that will give you multiple opportunities to get into it, right? A truly strong gap and go just runs, right? So what I mean by fading it is, let's say if I'm in a gap and go, and let's say it does this move like this, and all of a sudden up here, I get a beautiful evening star reversal. I am not taking that short. Okay. So that would be fading it. That would be going the opposite direction of this move, of that trend. So per my rules, I cannot take I cannot fade a gap and go. I cannot go in the opposite direction of that trend. Okay. It's already in my plan. Good job. Lesson learned. See, not a mistake. It was a lesson learned. Next point. Be cautious only take low of the day or high of the day breakouts in the first 90 minutes of the market before 11 a.m. Okay. So I don't take breakouts anymore. I could delete that from my plan because I now have in my plan, I don't take breakouts. And those of you who trade with me know that I don't take breakouts. I wait for the breakout to happen, and then I set it. So let's say if it's a bullish breakout, I then set up a limit buy. I don't take a breakout because there are way too many traps. And we talked about traps a lot today. Well, we talk about traps a lot every time we're on the mic, but talked about them a lot this morning, right? The traps happen constantly, more and more and more. So breakouts and breakdowns don't work as well in this market as they did years ago. So even though I have that in there, but it's still a good rule that only take because if you think about after 11 o'clock, if something has made a big move and you take a breakout or breakdown, you're either buying at the high or selling at the low. But before 11 o'clock, and quite frankly, that should really now just probably be like 10, 10, 15, the way the market's been. So anyway, I'm actually going to delete that now that we're going through my plan. I'm going to delete that from my plan entirely. And I'm going to just put in a part in my plan that says, don't take breakouts or breakdowns, let price breakout, breakdown, confirm the direction, then get in on a limit buy or sell. That will be my new rule that I'll use to replace that. Okay. Now this next one, I don't know. I mean, I have it here, but it's something that I just have more of as a reference. Okay. So be cautious when entering a new trade after 11:30 a.m. So sometime around 11:30 noon, that's when the lunch hour begins, right? So lunch hour, traditionally, that's when the institutional investors, big money, like they take lunch, right? They take a break from the screens, they go grab lunch, things slow down. So if everyone here has been following the markets during the time period of like, let's say 11:30 to 1, there's a lot of chop. And there's a reason there's a lot of chop is that the big money is not really participating that much during that time because a lot of them just go and they get away from the screens. So I just have that as a reference that after 11:30, I'm going to be cautious. So I'm really looking to get into a trade now as close to 10:30 as possible. Okay. So I'll wait an hour after the market opens. And then I've just, from what I've done in my back trading, all of the setups that I look for have been happening right around that 10:20, 10:30 area. So again, things can tend to slow down during lunch, but then be aware that at 1 o'clock, that's when things tend to pick back up. And you'll notice over and over, right? It doesn't have to be exactly 1 o'clock. I'm not saying 1 o'clock to the minute, but you'll notice that around 1 o'clock, volume starts to pick back up, right? So when I am trading, I will trade the morning and I'll trade, let's say from, market open until 11:30. I'm always a little, that's not to say I won't take a trade at 11:30, but I start to just be a little cautious about getting into a new trade at that time. And then I'll look for a trade somewhere between 1 and 2 o'clock. And then somewhere around 2 o'clock, if I haven't gotten in anything, I won't bother. I'll just pass. I'll shut it down and go to the gym, do whatever. The other thing that I am going to add in here that, what was I just thinking about? There's I just had a thought of a new, see, this is what happens when you're 56, right? Thought comes in your head, and as soon as you think of it, it's gone. So it'll come back to me at some point. If I stop thinking about it, it'll come back to me. So let me show you, let me clear all of this here. So I've been talking a lot, and that's because there's a lot of information here that we're going to cover. And we have about another half an hour to get through everything because Robert, RT3 is going to be late getting in. So I'm going to be running a little over. And so let's just I'll take a break from talking, and please post questions if you have questions. Give me a chance to grab a sip of water. I'm sitting here, I'm not walking away, but if anybody has questions, comments, thoughts, go ahead and post it in the chat. How do I remember when I should change a rule? Well, when I'm reading through my trading plan and I see something that's no longer relevant or pertinent to my how I trade, that's when it's time to change that plan. And just, so like right now, Albert, I think maybe you asked that question early on. Somebody did. You know what? here's my thing. When I say how much time to devote to back trading a week or on a daily basis, every single day, at the end of the day, I try to find time to, I certainly review my trades, right? So back trading is also logging your trades. So when I go back to a trade, like I have to go back to Delta today, and I'm going to take screenshots and I'm going to post it into my OneNote where I keep all my trades, and I'm going to put all my notes in there and I'm going to look at it. I'm going to analyze it. That's back trading, right? Because I'm going back and looking at that trade. Now, I will then also, so right now I am focused on 8 stocks, and I will go back and I will look at every single one of those on a 3-minute time frame, 5-minute time frame, whatever. I'll just scan through them, you know, for today's price action and see what did I miss and what time was it? You know, how did I miss that? Should I have missed it? Was it, you know, was I doing something else? Was I distracted? Was I in another trade? You know, so I will do that every single day, and I'll try to devote, you know, at least an hour, maybe, you know, depends, hour, 2 hours. When I log my trades, that could take, you know, 15 minutes per trade to log it because I put a lot of detail in. So if I had 2 trades a day, and, you know, and even though the trade that, where I got triggered in and then it canceled the trade on me because I was exceeded the lot size, I'm still going to log that because it was still a trade that I actively attempted to take, but I'm going to put it in there and I'm going to, you know, lesson learned, be aware of your lot size, right? So case in point, when I got into, so that was the Delta, that was when I tried to get Delta short. When I went long on Delta, I actually modified. I was forced to, because again, when I set my setup for going long had a lot size of 25. Well, I learned my lesson and I knew that I couldn't do a lot size larger than 20. So I adjusted that and I did a lot of 20 versus 25. So that's, you know, let's say today, that's going to be 30 minutes of time that it's going to take me to put it in there. Then, you know, I'll go back and I'll probably spend another 15 minutes. So it might be 2 hours, right? If I don't get to it tonight, I will do it first thing in the morning. So I'm always either getting to it end of day when it's fresh in my mind, or I'm going to go do it first thing in the morning, right? But if a couple of days goes by, then you start to forget things, and the things that you thought of, you know, in the moment are gone. So TradingView Pro allows only 5 indicators. What are my top 5? So look, part of my, I'm not going to spend a lot of time on it because it's about building the plan, but back to my presentation that I do of how to become a consistently profitable trader. I am going to do that presentation. I think it's next week. Let me, if you give me a minute, I can actually tell you. You're still all just seeing the whiteboard, right? Yeah. Okay. So next week, trading strategy, tuition on setting templates. Okay. It's actually Tuesday, the 19th. Tuesday, the 19th, I am doing the presentation at this time, 3:30. So write it down. I'm doing the presentation, becoming a consistently profitable trader. I'm going to do the presentation that I do at the retreats. Okay. But to answer your question, okay, top indicators. Part of my presentation I go into, I have a section where I talk about trade naked. Okay. That's the heading for this particular part of my presentation, trade naked. And I don't mean literally sitting, Justin. I don't mean literally sitting in front of your computer naked trading. I mean your screen, your charts. Keep them as clean as possible. Okay. I used to, when I first started out, and I assume this is, it says Tim V. So I assume its first name's Tim. I'm going to go with that for now. So when I first started trading, I got to tell you, I was that trader who was in search of the Holy Grail. I was like, there's got to be an indicator out there that's going to give me edge. There's got to be one indicator that is going to make me perform. And I spent so much time. No, Justin, I never did find it, but I spent a lot of money looking for it, and it does not exist. So for all of you who have not yet spent all that money searching for it, don't waste your money. It does not exist. And so back to the question, I use as very few indicators as possible. Okay. I use moving averages. Okay. I use the simple moving averages and the exponential. And those are, I use, that's not true. And I use volume, price level volume, right? So what you need to understand, okay, I'm going to touch on this real quick, but I'll go deeper into it during that presentation on the 19th. There are two types of indicators. There's leading and lagging. Okay. Leading indicators consist solely of price action and volume. And you could trade off of nothing but price action and volume. Those are your two leading indicators. Okay. Lagging indicators need the volume and price to have taken place to present themselves. Oh, and VWAP. I do use VWAP as well. Thanks, Rock. Trying to remember all the things that I use. So what I mean by that is volume and price action. A candle has to close, and then it records the price action and the volume. Only after that data is collected do the lagging indicators update. So your moving averages are lagging indicators. Okay. If you get into the whole like MACD and Bollinger Bands and this and that, I mean, there's too many. They make your head spin, all the indicators, right? And yeah, some of them are applicable and you know, they're nice to watch, but you know what they do? They make you overthink stuff. And yeah, less is more. Exactly, right? So RSI, MACD, VWAP, I do like VWAP. So, but Emily's right. You do suffer analysis or paralysis through analysis, because you're looking at all these indicators and you're trying to decide, are they all telling you to take the trade? And by the time you finally decide that they all have told you to take the trade's gone, and now you're chasing it. So I use very little indicators. I pretty much look at volume, the price action, my two main things, because those are the leading indicators. And I look at the moving averages, support, resistance. That's it. So I hope that answers your question. But again, I will touch more. I'll touch more on those indicators when we get together on the 19th. So make a note if you want to join me. Yeah, Emily says you should have a few. You know, pick a couple that work for you. But you know, overloading your charts with all these indicators is just, you know, it's too much. All right. So let me highlight this. Copy. Let me put this in here. Where do we find out? Oh, the trading room schedule. Yes. Hang on one second. Let me see if I can get this into. Okay. So that's everything I just covered. I'll leave that up there for a minute. So Manveer, if you go to reallifetrading.com, okay, let me show you. Let me do another share briefly. If I can find which one I'm looking for. Here we go. Okay. So go to reallifetrading.com under live trading, right? Click that, and that takes you to here. Scroll down, and here's the trading schedule for the month, right? So here we are right here, building a trading plan. The 19th, right there, becoming a consistently profitable trader. So that's the schedule. So any of you who weren't aware of that, that's where you're going to find out. And you look, we have great content every single day between the hours of 2 and when the afternoon swing room starts. We have different things going on every single day. All right. So that answers Manbear's question. Let's go back to my screen share. Let's go back to my whiteboard. Okay. So again, so that's everything that we just covered. Okay, those are the general guidelines. So I'll leave that up there for a second. Any other thoughts, questions? Bianca, you're welcome. This is recorded, so check Slack for the recording. All right. I'm going to pick up the pace because I'm realizing we have 20 minutes before Robert is going to appear. All right. Yep. Okay. So clear this. I'm going to start picking up the pace. Tony, plan is very detailed. Presumably it's been updated over a long period of time. Yes, based on experience. That is correct. Problem is if you're a new trader, you do not have experience to know things to consider, what works. You're right. So all the more reason, okay? If you are a new trader, so Tony, let's say, and I'm just going to use you as an example because you posted the comment. If you're a new trader, okay, email me. I gave you my email before, but I'll give it again. Stephen, STEPHEN @reallifetrading.com. So I already said before, if you want to email me and request a copy of my trading plan, I will send it to you. If you are a new trader and you are developing your trading plan, mention that to me. I will send you the trading plan with key things highlighted that you should absolutely include in your trading plan. Okay. There are things on here that are not applicable to everybody. I understand that, but there are things that I will tell you that you absolutely should include in your trading plan as a new trader. Okay. Does that help you, Tony? Does that make sense? You're welcome. You are welcome. So be sure to tell me, new trader, what are the key things I need to know? And I will highlight those items and send them to you. Okay. Risk management. That's my next category in my trading plan. Consistently use a predefined R. We already talked about that. Don't change your R. Okay. You want to have a nice, clean, steady profit, right? You want your profit. If you were looking at your profit curve, right? Your profitability, you want it to look something like that, right? You want it gradually increasing, right? You don't want your profit curve to look like this. You don't want it to look like a trading chart, right? You don't want to have big wins, big losses. So trade the same R all the time. Again, the caveat to that is if you are testing out a new strategy, okay, go with a half R only for that strategy. And then trade that strategy, take 20 to 30 trades, okay? You can't determine whether a strategy is viable or not off of 5 trades. It's not a big enough sample. You need to have 20 to 30 trades on a new strategy to determine if it is a viable strategy. So if you want to reduce your R to half, a quarter, doesn't matter. As long as you're putting some real money on the line and you get in 20 to 30 trades on that strategy to then determine if it's viable or not. This is a pretty good one. Now, and this does not apply to Tesla. So I'm going to state that up front, but I didn't trade Tesla for a long time. Okay. Spread can be no more than 10% of the trade risk. And what I mean by that is it's the difference between your entry and the stop. Okay. So if to give you an example. Okay. So let's say you're trading something that is a $100 stock and the bid is 100 and the ask is 120, right? So that's greater than 10% or greater than 10%, right? So I wouldn't be able to take that. So I look at if my risk is if I set up a trade and let's say my risk is 25 cents, that's my risk. And that risk is obviously the difference between the entry and the stop, right? I think I said this wrong before. I'll clarify. Spread can be no more than 10% of the trade risk. That's the difference between the entry and the stop. I think before I said bid and ask, I meant entry and the stop. Okay. So if my risk is 25 cents and I'm trading Tesla, which has a 40-cent spread, I can't take that. I can't trade that. Now I do trade Tesla now, right? But for new traders, don't trade anything that has a spread more than 10%. And the reason being is the spread can kill you. Okay. So if you're looking at Tesla and you are risking a full R and Tesla hits your stop loss, and let's say you haven't moved your stop at all, okay, it hits the original stop loss, your loss is going to be greater than 1R. It could be 1.4R, 1.5R. Okay. So especially for new traders, people struggling, developing traders, great rule to adopt, that the spread can be no more than 10% of your risk. So if it's 25 cent risk, 10-cent spread is okay. 30-cent spread, 30-cent spread, not okay. Now this is doesn't apply to me anymore. Again, something I need to take out of my plan. But new traders, okay, if you're just starting out, right, you're learning, get the reps in, but don't overdo it. So I said for the first 3 months of trade, this is from my original plan, first 3 months of trading, no more than 19 day trades per month. Okay, don't overtrade. Look for the best setups. Don't take every setup you see. Look for the best setups, the ones that are going to give you the best edge, the best possibility, potential for profit. Okay. This is key. So we're under the category of risk management. These next few things I'm going to talk about, back to whoever it was that was asking about, what if you're new? I think it was Tony, right? And these next things I am going to tell you absolutely should be in everybody's plan without fail. Maximum loss limits. Okay. I can have no more than my maximum loss per day is 2Rs. If I hit a 2R loss in a single day, I'm done. If that happens by 9:45, I'm done. If that happens by 9:35, I'm done. I don't take another trade. And the reason for these maximum loss limits is to prevent the pitfalls, the psychological pitfalls you experience from losing. Okay. Because what happens when you're down 2R? Now you're basically revenge trading. You're forcing yourself to find trades to try to make up that loss. You're psychologically and emotionally compromised. Shut it down. Right. So for those of you who see in Slack when people post, oh, I lost 20R this month, I lost 30R this month, I look at those comments and go, you wouldn't be in this position if you had some rules, some solid rules around maximum loss limits. So again, mine are maximum of 2 losses per day. And if I hit that, I'm done. No more than 1.5 loss on any individual stock or trade. So caveat to my rule about the predefined R. Okay. I do have a rule in here that allows me. So let's say I take a trade on Tesla and I lose 1R, full R loss. If I see another setup on Tesla, I can take it, but I have to reduce my risk on Tesla to a half an R. So that is a caveat to my predefined R rule, which is I cannot lose more than 1.5 R on any individual stock or trade, right? So if I'm going to take a second trade on something where I've already lost an R, I have to reduce my R to 0.5. Okay. I have a maximum loss per week of 5R. Okay. So if I hit 5R loss, well, I couldn't do it in one day, right? Because that's why I have my maximum of 2R loss on a particular day. But let's say I lose 2R on Monday. I lose 2R on Tuesday. So by coming into the trading session on Wednesday, I'm down 4R. How many R's can I risk now? Go see if everyone's good. Yep, just one. That's it. So the purpose of these rules are to protect my capital. I'm not just looking at controlling my losses. More importantly, I'm looking at protecting and preserving my capital. Okay. I don't want to take more than 5R losses in 1 week. Because again, you lose more than 5R in a week, you're now emotionally and psychologically compromised. You're going to take bad trades. So going into Wednesday, if I've already lost 4, I can risk 1. if I win one, right? Yeah, hard to come back. So I'm down 4. Let's say Wednesday, I win an R. Now I'm down 3. Thursday, I can still risk 2R, right? So just do the math and keep track of it. All the more reason why you should be logging your trades, recording your wins and losses. You have to know every single day, where are you in terms of your R's? Okay, are you down? Are you up? Where are you? Okay, you're welcome, Petra. Good luck with that 75 hard. Again, it's recorded. My monthly max loss, I have a max 10R loss per month. If I am down 10R at any point in the month, even if I'm only halfway through the month, I shut it down. I cannot take a live trade. Now, that doesn't mean I don't follow markets. That doesn't mean I don't trade any paper trade. I can paper trade all I want. I can't take a real trade and put real money on the line. So again, purpose of having these loss limits is to preserve your capital. Okay. Do you change things when you are down 8R knowing you have? No. So Justin, if I'm down 8R, I'm going to be very, very selective with the trades I'm going to take. So, I have my max R. So if I'm down 8R, let's say mid-month, right? I've got 2R to go. I can risk an R on 2 more trades, assuming they're losers, right? But, I can still trade, but I'm going to be extremely selective about what I trade. Okay. And, Jeremy has a great saying, he says, okay, looks at a trade you took, and let's say if it was losing trade. He's like, okay, if you had a $100,000 R, would you still have taken that trade? And if the answer is yes, then it was a good trade. 10, yes, there is going to be the swing room starts at 5. Robert Thompson is running late. So another rule I like, that I will go at least 2 full days of the month looking at charts and not placing a single trade, right? Another good rule. So you don't have to trade every single day. Take some time to just sit there and just watch, soak it all in, right? Even experienced traders, there's nothing wrong with taking a 2 days. And I usually do those on Fridays. I don't like trading on Fridays. Those my least profitable days. So if I'm going to do this, I'll do it on a Friday. Especially do it on a Friday when it's witching hour, right? When option expiration, and things are just going to be insane, right? Just take the day to watch, just soak it all in. All right, so here's my risk management. Let me copy this. Okay, there's everything we just went over. I'll just leave it there for a second. We're almost done. We have 7 minutes for me to cover the last part. Okay. And I'm going to just fly through it because I know Robert's going to be like 5:15. Okay. So there's your risk management component. And if I update this, I will let everybody know. Okay. The final part of my trading plan, trade entry and management. Okay. So that's the heading. And then I have all the bullets underneath it. Okay. There should be apparent and likely 1 to 2 to 1 to 3 reward versus risk in order to take a trade. Now, market's different today than it was back when I wrote this plan. Back there, it was common for things to run to 2R, 3R. Today, it's very choppy. So that's why I've now adopted the 10 EMA strategy rule of 1.2, right? That's my minimum. But when things turn around and the market is less volatile, then I'm going to start looking for a 2 to 1, 3 to 1 reward to risk. Must plan a trade at least 5 minutes in advance. So you don't want to just see a trade set and jump in immediately. You want to, if you see something setting up, go do your time frame analysis, look at it on lower time frame, higher time frame, compare the charts, see if everything's in sync. Give yourself 5 minutes to plan the trade. So must plan a trade at least 5 minutes in advance. If the trade sets up per my plan, then I have to take it. So there's a rule that forces you to take your trade, and you don't hesitate. You don't hesitate on clicking that button, because if you set it up and you followed your rule and you set it up 5 minutes before and that trade sets up, you have to take it, right? So it's forcing you. Now you have a built-in plan here, rule that says you have to take that trade if you set it up. Okay, really good one here. May not enter a trade in either direction that has 4 candles of the same color in a row in the same direction of the trade. Look for at least 1 candle in the opposite direction. Okay, so happened today. I was looking at a setup and there were 4 or 5 bullish candles in a row. Right, the old days, I'd be that guy buying after 4 or 5 bullish candles. Don't do it. If there are 4 or more candles of the same color in a row, wait for a pullback. Yep, exactly. Don't chase. Here's look, everyone has their different things. I do love using a 5-minute 2-bar trailing stop. Okay, if you do some back trading, I can't get into all the details of that trailing stop rule, but I know what the criteria is for me, so I don't have it spelled out in my rules here, but I say use a 2-bar trailing stop and move the stop to break even as quickly as possible without risking getting whipsawed. Okay. There was, I did update this other day and it must not have saved it. I don't know why, but I am adding a rule now that, let me see if I can verbalize it since I didn't write it down. But so these are for stops. Okay. So back to, I like to use a 5-minute 2-bar trailing stop. And so as long as the price, let's say if I'm in a bullish trade, as long as it's making higher highs and higher lows, I will trail the stop 2 bars behind the current price action. So bar closes. Yeah. So again, I don't want to run out of time. I'll do this quickly, but let's say I'm in a trade and sorry. Okay. I get this candle. I get this candle. I get this candle. I get this candle, right? It's making higher highs and higher lows. Okay. Once this candle forms and closes, okay, as long as it made a higher high and a higher low, I count back 2 candles, 1, 2, and my stop goes down here below this candle. Back trade it. It works remarkably well. I have coaching students who I'm working with who are implemented that, use it. Don't just implement it immediately, back trade it, but higher highs and higher lows. That's the key thing. Again, there's other nuances to it, but that's the main thing, is as long as it's making higher highs, higher lows, or if you're going the other, 5-minute, Hector, or if it's going the opposite direction, lower lows, lower highs, lower lows, right? As soon as this, you got to wait for the candle to close. As soon as this candle closes, and then let's say price action opens here and it starts to move, count back. So from after this one closed, 2 candles, 1, 2, right below that candle. Back trade it. It's works amazingly well. Check it out. Okay. My new stop rule is that I cannot move my stop. See if I can verbalize this properly. I cannot move my stop after a candle form that is in the opposite direction of my trade. So what I mean by that is, let's say I'm in a trade, and again, I'm not going to color code all these, but I'm in a trade like this, and I am, I'm long, right? And my stop currently is down here. All of a sudden I get a candle like that. So I got bull candle, 1, 2, 3 bull candles. I get this crazy bearish candle. Okay. Then the next candle opens. I cannot move my stop here. I can only move my stop after it makes another bullish candle. So let's say, and I'm afraid that the trade's going against me and I'm wrong about, let's say I entered here, right? And it went my direction, 3 candles initially, and now it looks like it's going to sell off hard, right? Yeah, moving with fear, exactly. I have to wait for, if I'm in a bullish trade, I cannot move my stop here on a bearish candle. I have to wait for another bullish candle. Once that bullish candle comes in, then I can move my stop here. Okay. Again, I don't have that spelled out in writing. I know for sure I wrote it in my plan, but I didn't clearly save it. Okay. If a trade goes in your direction, even 1 penny, do your best to lose less than 1 R on the trade. Okay. So Jeremy, sorry, let me clear this. Jeremy has, I'm taking on his new rule, which is his first stop movement. He's going to move it so he loses 0.7. So you go from 1 R, first time he moves a stop, 0.7. Next time his move is a stop, he's only going to be losing 0.5. Next time he moves a stop, it's 0.2. Then he will move it to break even, and then he will start moving it profitable. Okay. So if a trade goes your direction, even by a penny, do your best to lose less than 1 R on the trade. Don't let price move in your direction and then come back, and don't allow a good winning trade to turn into a losing trade. Okay. Happened to me a lot. I would sit there, I would watch it run to 1 R. I hadn't taken anything off. I hadn't moved my stop, turn around, and it would take me out for an R. I'm like, what happened? Right? Don't let a good winning trade turn into a losing trade. If it moves your direction, even at 1 penny, do your best to lose less than 1 R. Okay. Don't panic close a position, trail out, or get stopped out. Okay. So that kind of plays into what Rock was saying about moving your stop based on fear. Don't do it. And get stopped out or get trailed out. Okay. So I'm going to read that again. Do not panic close a position. Okay. I know a lot of people have a tendency, all of a sudden you're profitable and you're like, oh, I'm just going to lock it in. And you click, close the position. And next thing you know, it runs right to your target. If you just moved your stop, right? Don't panic close. Let it go to your target, or let yourself get trailed out or stopped out. But don't panic close just because suddenly, let's say you lost a trade and you're down $300, and suddenly you're in a trade and now you're at break even on your P&L because you just made 300, you're up 300 on this new trade. And you're like, you know what? I got to get out now. I can just, get out for break even. And then you panic close it. Great. Your P&L might be at break even, but then you watch it run to your 1 R, 2 R target, and now you would have been profitable on the day. So the point there is, don't panic close. Put a sticky note on that P&L. Exactly. Let's see if I just added this rule. So now if I'm in a day trade and it's really working out well, sometimes, you'll talk about people saying, I'm going to add to that position, meaning they'll put another R on the line. Like, so let's say they nailed the entry and price immediately went their direction, and clearly it's going to be a home run trade. A lot of times people will add to that trade, and I've done it before. I do it. I will look to add to the trade. So you're increasing your you're not really increasing your risk, because you're adding it at a point where you're now already profitable. But I won't get into the details of adding to a position. But what I say is my new rule is I can only add to a trade. So I'm talking about day trade. I can only add to a day trade if I'm currently up 4 or more R's on the month. So once I'm up 4 or more R's on a month, then I can take a little bit more risk with adding to a position. But until that point, I can't. I have a couple of other things that I'm not going to go into. I'll post them. I'm going to copy this. Let me put it in the text here. There are a couple of things I did not go over here. I didn't go over these last couple of things. I got a couple of rules about credit spreads. The credit must equal 10 to 20% of the difference between the strike. I'm not going to get into that because it's an option related thing. This down here, the selling covered calls, is also an option, and I want to get into that during this conversation. Inside bars, right? I just have a thing here that says need to close above or below the high low of the prior candle to confirm a direction, and that is true, right? So part of the, if you were with me this morning, you know, I or any day, if I see that we are trading and it's an inside day, inside candle, I'm very cautious. Okay, because when you're trading inside a prior day's range, it hasn't picked a direction. It can just chop. It can just keep moving, you know, around, up and down, and not go anywhere. So the key thing there, the key takeaway there, is that when you have an inside bar, just know that it has to break the higher the low to confirm the direction that it's going. Okay. Let's see. I don't know if, let me see if Robert is here. Okay, Robert's not here yet, so we can keep going for a few minutes. All right, so far, what do you think? Is this helpful for everyone? Give me a 1 if you are still paying attention and still feeling like this is definitely helpful. Great, cool, good. I have just been rambling for over an hour and a half, but there's a lot to this, right? So let me just then let me clear this out. And again, I am recording this, so let me clear this out. Let me go to a different share. So let me go to screen 2. Okay, here you go. Can everybody see my plan? Give me a 1 if you can. Yep. Okay, so there it is. That's what I've been reading to you the entire time. Okay, so here's my mission statement, as somebody put it, right? So there's my mission statement. Keys to consistency, outlined. General guidelines, outlined, right? Again, general guidelines, key takeaway there: what you trade is as important as how you trade. Let's see. Risk management, again, and I could probably expand this, right? There are a few more things I can do to put in there for risk management. Trade entry and management. Other considerations, I didn't throw this up here, but I'll just mention it since we have a couple minutes, that, you know, just remember that blue chips don't trade like some other stuff, you know, like other things that we look at. Blue chips they don't move, right? Like, you know, you might get a gap down on a blue chip and then just gets bought up. So, so anyway, just something I just remind myself of, okay, that the blue chips don't move like other things. Okay, so Albert, any special trick to remembering the rules? A lot. Yes, print out your rules and have them sitting right next to you when you're trading. That's the best advice I can give you. Because, and again, back to right here, back to what I said about the daily routine. Read your plan every single day before you start to trade. Make that part of your daily routine. Review that plan. Look, the more that you review it, the more it's going to get ingrained in your memory, right? So read it every single day. Reference it while you are trading. I do it. I'll look and go, wait, I know I have a rule about that. What's my rule, right? Maybe I don't do it so much anymore because I do have all this, you know, committed to memory, but I do still have this printed out and sitting on my desk with me. So let's do this. Because okay, Robert's here. So give me 1 second. I just want to finish up, and then I'm going to stop the recording before I turn it over to you. So last thing I want to leave you all with, okay, the final thought here, okay, a winning trade, okay. Here's my last bit of knowledge I'm going to share with you, okay. A winning trade is not a good trade if you didn't follow your plan. Think about that, okay? You made money. Yeah, that's good. But is it a good trade if you did not follow your plan? Okay. And conversely, a good trade can be a losing trade as long as you followed your plan. So I will tell you that some of my best trades I've ever had were losing trades, but I follow my plan to a T, and I could walk away from that and go, my analysis was good. I follow my plan exactly. Yes, it was a loss, but that was a good trade. So there's my final thought. Let me stop the recording before I turn it over to stop the recording.